Over the last few weeks, there's been tremendous excitement about the T+1 settlement that stock exchanges are moving towards. Lots have been written, lots have been spoken. But what is it all about? Is it worth all the hullabaloo? That's what we're going to talk about in today's episode. But we're also going to talk about the larger aspect of liquidity in investing. What does liquidity mean for investors? Liquidity is the ability to convert your investment to cash. While it may seem a very simple job, it's a very, very important characteristic of an investment. Just as returns, risk are different characteristics of an investment, liquidity is a very, very important characteristic of an investment. Your ability to encash and make it cash really is the ultimate proof that you made returns. You don't get returns just by staying invested on paper. It needs to come back to you in the form of cash. Now that's where liquidity plays a big role. Traditionally, people haven't been too focused about liquidity in investments, but of late, there has been a lot said and done about being able to liquidate one's investment to realize the gain or profits. On one side, different asset classes work very differently on this parameter. Just as returns in different asset classes are different, so is the liquidity in each of them is also very, very different. For example, if you take real estate, it's a great asset, but liquidity is hard to come by. Difficult to sell. Suppose you own a property worth 1 crore rupees and you want 1 lakh, it's not possible really. You have to sell that entire property to realize liquidity. Realizing liquidity also takes time. It's not like you can go out into the market and take money next day onwards. You'll either have to sell the entire property or find a way to take a loan against the property, both of which is a reasonably cumbersome. Sale is of course a couple of months, if not a year's time. Loan is a couple of days or weeks process. So it's not the easiest of things to be done. On the contrary, if you take a bank deposit, it's the most liquid asset that one can invest into. Why? Because you can just walk across to the bank or call the banker and ask him to encash the deposit. At best, you may lose some penal interest, but the money will be in your account the very next second because it's within the same bank. So you can then issue checks or issue UPI payments against the deposit which has been credited to your bank account. So it's the quickest of the form. Now, unfortunately, while it's the quickest form, it's not the most rewarding. Keeping money in FD is not tax efficient. The rate of return that you get minus the taxes hardly cover for inflation. So it doesn't help from inflation. Therefore, if one wants to make a choice between taxation and liquidity and get the best yield with the best possible liquidity, I think there are two places one can look at. One is mutual funds. And mutual funds offer a wide variety. Even within the debt fund, you have categories starting from liquid fund to short-term funds and various terms, depending on time horizons that provide you anytime liquidity. In fact, the liquid fund, as an example, gives you almost equivalent to a 1-year FD kind of a rate, but gives you next day morning liquidity, 24-hour liquidity. So it's a great product for somebody who wants safety of principles as well as wants a quick liquidity to happen. Starting from there, even if you take an equity mutual fund, if you've stayed invested for whatever be the time, if you want money for an emergency, you can liquidate it and get your money in 3 working days. So it's T+3 in equity mutual funds, which means transaction days plus the 3rd day thereafter, you should get your money there. So it's as liquid as that. When you deal in shares and stocks, was T+2 till very recently, which means if you sold a share today, then 2 days hence the money should hit your bank account. That's as quick as it was. Now it's been made quicker. It's now on a T+1 basis, which means if you sell your stock today, next day the money will hit your account. That's super cool, ain't it? And in fact, India and China are arguably the only countries where transactions are squared off so quickly because we are entirely electronic when it comes to stock trading. So it's a fantastic development. And what is even more earth-shattering is that we believe that the ability to liquidate one's equity investment is so quick today that over the next couple of years or maybe even a decade, a significant amount of money that people would want to keep in liquid places will move either to mutual funds or stock market, given that they know that they can liquidate at the shortest possible time. So this whole process of keeping liquidity at the helm of the investing process, both at mutual funds and now the earth-shattering T+1 settlement for stockbroking, is going to change how Indians invest going forward. I look forward to a day when both stock markets and mutual funds will have more transactions and more money than even the banking system. That's not far. And this T+1 is just the next move towards that. I hope you take cognizance and you find ways to kind of use this as a great opportunity to deploy your money and hopefully generate great returns. Of course, I must warn you that equity is not for short term. So do not look at this as a way in which you can make money in the short term. That will be speculation. But it's important to know that irrespective of having a large portfolio in equity, you can generate liquidity quickly thanks to this T+1.